So you're scrolling through the morning financial news and you see it again. Some company is suddenly being bought for literally billions of dollars more than it was worth just the date before. I mean, it happens all the time in corporate mergers and acquisitions, but you have to wonder, how do the buyers actually justify those massive price tags? Are they just blindly throwing money around in a bidding war, or is there a rigorous mathematical framework behind it? Well, that's exactly what we're going to dive into today. In this explainer, we're unpacking the valuation framework developed by finance expert Aswath Damodaran. We're going to learn the steps of valuing target firms for an acquisition, specifically focusing on how to mathematically value synergy and control premiums. It's an absolute game changer once you see the math.
Here's a quick roadmap for today's explainer. We'll start with the acquisition premium trap, set our status quo, value corporate control, demystify synergy, calculate its real value, and then wrap up by structuring the final deal.
All right, let's kick things off with Section 1, the acquisition premium trap. This is the billion-dollar question, right? Why do companies pay massive premiums to acquire other firms? Are the CEOs of these acquiring companies just falling victim to the bigger fool theory, kind of hoping someone else will pay even more down the line? Or are they actually buying real calculable value that the rest of the market just can't see? Before we can really answer that, we need to pin down what we're talking about. The acquisition premium is simply the difference between the acquisition price, the actual check the buyer writes, and the market price of the target firm prior to the acquisition. So think about it like this. If a company is trading at $100 million and you step in and pay $130 million to acquire it, you have to mathematically justify that extra $30 million. You can't just wave your hands. You have to prove it's not just some vanity purchase for the CEO. To justify that premium, we're going to build out the maximum purchase price using a really logical three-step valuation staircase. We move from the familiar right up to the highly complex. Step 1 is the status quo valuation. Step 2 is adding the value of control. And step 3 is adding the value of synergy. By strictly separating these steps, we make sure we don't end up overpaying for vague promises.
Moving right along to Section 2. This is Step 1 of our staircase, establishing the status quo. Look, before you can even dream of synergy or massive corporate overhauls, you have to establish a solid baseline. You have to value the target company exactly as it is today before a single change is made. This base value uses the firm's existing investing, financing, and dividend policies as they stand right now. It's purely a function of the cash flows the company is generating today from its existing assets, alongside its current risk profile. Honestly, if you skip this baseline step, you completely lose your grounding in reality. Now for Section 3, and this is where things start getting really interesting, valuing corporate control. Okay, here's a fascinating twist. The very first layer of our premium, the value of control, is literally the difference between the value of the firm, if it were optimally managed, and the value of the firm under its current management. What does that actually mean? It means that, counterintuitively, poorly managed firms are the ones that offer the greatest potential value of control. If a firm is already perfectly run, this value is basically zero. But if the current management is lazy, if the company is bloated, or if they're using a terrible capital structure, well, an acquirer can step in, clean house, and unlock tremendous value almost immediately. Let's ground this with a historic example, the famous Compaq acquisition of Digital. Now, at the time, Digital was widely viewed as a pretty poorly managed firm. Aswath Damodaran's rigorous analysis shows that under its existing management, our status quo baseline, Digital was worth about $2.1 billion. But if a new owner stepped in, raised the debt ratio to a much more optimal level, and lowered the cost of capital, the firm's optimal value absolutely skyrockets to $4.5 billion. Just doing the simple math here, subtracting the status quo from the optimally managed value gives us a concrete value of control of $2.4 billion. That is literally billions of dollars created simply by running the business better. Which brings us to Section 4, reaching the top of our valuation staircase, demystifying synergy. Synergy. It's the holy grail of M&A, right? It's this enticing idea that combining two firms creates additional value that simply didn't exist before. Now, we all know it's probably the most misused buzzword in business history, but it does have real tangible sources, and they break down into two main categories. First, you've got operating synergies. These allow firms to directly increase their operating income or growth. We're talking economies of scale, greater pricing power, or maybe combining a killer product with a massive marketing distribution team. Then you have financial synergies. This is all about the math of money. Maybe you're combining a cash-rich firm with a firm that has high-return projects but zero cash to fund them. Or you're getting massive tax benefits like net operating losses. The point is, synergy isn't magic. It's very real. It's either boosting cash flow or lowering the cost of capital. Let's dive into Section 5, calculating synergy's real value, because we have to put a hard number on it. So how do we actually attach a price tag to this concept? Well, first, we have to establish what the two companies are worth if we just duct tape them together, without changing a single thing about how they interact. Going back to our Compaq and Digital example, we take Digital's optimally managed value, that's $4.5 billion, and we simply add Compaq's standalone status quo value, which is $38.5 billion. That gives us a combined baseline value of just over $43 billion. This is our strict no synergy baseline. Now, we finally bake in the synergy. Let's assume that combining these two massive tech companies creates genuine economies of scale, saving about $100 million annually in operating costs alone. When we bake that $100 million of higher margin into the financial model and we carefully adjust our cost of capital for the newly combined entity, we get a brand new, elevated schedule of expected cash flows. We aren't guessing anymore. We are forecasting exact mathematical cash flows based on highly specific operational savings. And here is where it all comes together. When you take all those new synergized cash flows and discount them back to present value, the value of the combined firm jumps to over $45.5 billion. If you subtract our $43 billion duct tape baseline from that new number, boom, you are left with exactly $2.4 billion. This is such a light bulb moment. Synergy isn't just some fluffy, theoretical concept you pitch in a boardroom to get a deal approved. If you know its exact form and exactly when it starts, it is a concrete premium that can be calculated down to the literal dollar. Finally, let's hit Section 6, structuring the final deal. Time for a reality check. We've proven the math works beautifully on paper, but the real world, it's incredibly unforgiving. Synergy rarely happens overnight. It usually takes years to actually materialize, which means its present value decays the longer you wait. Also, if you're targeting a poorly managed firm, the stock market might already know it's poorly managed, meaning a control premium could already be baked right into their current stock price. But the absolute most dangerous trap is overpaying. Think about it. If you calculate that synergy will generate $2 billion and you enthusiastically pay a $2 billion premium to acquire the company, you have just transferred 100% of the value you created straight into the pockets of the target company's stockholders. Your own stockholders get absolutely nothing. This is exactly why a famous McKinsey study found that a staggering 60% of merger transactions in the 1990s earned returns less than their cost of capital. Acquirers just chronically overpaid and gave away the entire premium. Which leaves us with a really critical thought to close out on. We know how to mathematically prove the value of a target firm, the value of bringing in new management, and the exact value of synergy. But when acquirers get into these huge bidding wars and pay out the absolute maximum of that calculated value just to get the deal done, if the target stockholders are getting all the synergy premium, who actually wins the acquisition? Are the buyers really the financial geniuses creating value, or are they ultimately just the bigger fools? Thanks for joining me on this explainer. I really hope this framework gives you a sharp, mathematical new lens for the next time you see a multi-billion-dollar merger hit the news.